Well, it's time for another Rogers Capital Market Commentary where we attempt to be the antidote to water cooler wisdom. Well, hope you're enjoying your summer. The markets are certainly enjoying the summer and the nice heat with a really strong June and July. We're now sitting here at a plus 19 for the first 7 months of the year. Not too bad. Well, we've been talking through 3 watch points, 3 drivers for the markets, really most of the year. The first is inflation. The second is the Fed's response to inflation with raising interest rates. The third is the economy as a whole, soft landing, hard landing. And really, we're still watching those factors. The Fed just recently, last month, released their results for the annual stress test on the big banks. 23 largest banks in this country put through a mock stress test where, really severely adverse scenarios to see how they respond, see what happens to their capital levels, their safety. And good news, passed with flying colors, exceeding those minimum capital levels, and really seeing, again, mock, but about $500 billion in losses. Key factors in that stress test included 6.4% rise in unemployment, which would be at 10% unemployment, a 40% decline in commercial real estate prices, and a 38% decline in housing prices. And again, passed with flying colors, which is interesting. I've heard a lot of talk this year about, well, here it comes again. Here it is, 2008 financial crisis coming all over again. We even had, bank failures, those California banks that struggled. But this stress test last month really providing some peace of mind as to exactly what we're dealing with from a financial stability basis. The Fed raised rates for the 11th time. That puts us at 5.5%. The next meeting is mid-September and remains data dependent, meaning they're going to wait and see what happens, remain flexible, not just go ahead and tell us that they're raising multiple times. So we as investors, we're going to get 2 more inflation reports. We're going to get 2 more labor market reports by the next meeting, which will give the Fed some flexibility to remain non-committal about future rate hikes. If inflation is soft enough and the labor market loosens, then we can reasonably expect that the Fed will even pause again in September, which markets will love. The Fed's likely at a balanced position right now, since the risk of raising rates too much when it's unnecessary is roughly balanced with the risk of raising not enough to stamp out the rest of inflation. Unemployment rate, interestingly, is at the same rate as it was before they even started raising rates last year, which means there's not really been a whole lot of pain just felt yet, as was suggested. Fed warning last year was that it's going to take pain to bring inflation down, and so far that hasn't come through, which is obviously great news. The consumer is the primary reason for that. You, me, the consumer continues to spend on travel and entertainment throughout the economy. In fact, growing more than expected in the first quarter. Pandemic-related distortions are still there and could create some volatility, supply chain, etc. But the economy though it's likely in a downshift and probably recession in the fourth quarter, it's looking more and more like maybe, soft landing. So the Fed's preferred annual inflation metric decelerated to 2.9%, less than 3% inflation from June, it being at 382. Previous month, overall inflation pressures eased. Core inflation even, which is inflation excluding food and energy, which can be, a little bit misleading. It also decelerated to 4.1% in June, down from 4.6. So you're seeing the trend. You're seeing what was supposed to happen as the Fed applies the brakes, things slowing down, inflation coming out of the system. All that money that we printed and pumped in throughout COVID, coming out of the system. So the recession that's probably, again, likely fourth quarter, but hopefully soft, that's what you're seeing the market respond to through the summer and even going forward. The things won't be as bad as they could be, and we can go back to levels like we were last year. Well, enjoy the rest of your summer. School going to be here before you know it. So enjoy. We'll talk to you in September.